Every market crash, every historic bull run, every record-breaking rally, and every devastating collapse that left behind the exact same clue, a clue that most traders saw, but almost nobody understood. For more than 130 years, this clue has been sitting on every stock chart, every futures chart, every crypto chart, and every Forex chart. Yet millions of traders continue to ignore it every single day. Instead, they search for the perfect indicator, the perfect strategy, the perfect candlestick pattern, believing the next trade will finally change everything. But here's the uncomfortable truth. The market has never rewarded the people who simply watch price. It rewards the people who understand why price moves. And that answer has almost nothing to do with your favorite indicator. It has everything to do with one simple word: volume. Intro. If you've ever bought a breakout that immediately failed, if you've ever sold at the exact bottom before the market reversed, or watched a stock continue higher after you thought it was already overbought, you're not alone. Because chances are, you were reading only half of the story. Most retail traders believe price is the market. Professional traders know something different. Price is only the final result. Volume tells the story behind that result. And once you understand that relationship, charts stop looking random. They begin to tell a story. Today, we're going to explore one of the oldest and most misunderstood ideas in financial markets, a theory that has survived market crashes, world wars, the dot-com bubble, the 2008 financial crisis, and even the AI-driven markets of today. Because while technology changes, human psychology never does. Fear, greed, hope, panic. These emotions still drive markets exactly the way they did more than a century ago. Price is the headline. Volume is the full story. Imagine waking up tomorrow morning and reading only newspaper headlines. You'd know what happened, but you'd have no idea why it happened. That's exactly how most traders analyze charts. They watch price move higher. They see a breakout. They see a red candle, a green candle, a new high, a new low, and they make decisions based entirely on what they can see. But price is simply the final score. It doesn't explain the battle that created it. Volume does. Volume represents participation. It answers one critical question: how many market participants actually believed in that move? Because not every rally is created equally. Not every sell-off carries the same meaning. Sometimes price moves dramatically with almost no participation. Other times, price barely moves despite enormous trading activity. And that's where the smartest traders begin paying attention. The invisible players. Let's imagine Apple shares rise 4% today. At first glance, that sounds incredibly bullish. But now imagine something else. Only a small number of shares were traded. Very few institutions participated. Most of the buying came from emotional retail traders reacting to positive headlines. Now imagine the exact same 4% rally. But this time, trading volume is 3 times higher than average. Mutual funds are buying. Pension funds are buying. Hedge funds are building positions. Now that rally means something completely different. The price looks identical. The story does not. This is the first lesson professional traders learn. Never judge price without asking who was behind the move. Why institutions think differently. Retail traders can buy 100 shares with a single click. Institutions cannot. A hedge fund managing $10 billion cannot simply press buy. Its order would move the market against itself. Instead, large institutions accumulate positions quietly, sometimes over days, sometimes over weeks, sometimes even months. While retail traders chase headlines, institutional money patiently builds positions, and every time they do, they leave footprints. Those footprints appear in one place: volume. This is why professionals often trust volume before they trust price, because price can be manipulated in the short term. Participation is much harder to fake. The biggest trading mistake. Here's where most traders lose money. A stock breaks above resistance. Everyone on social media calls it the beginning of the next bull run. Retail traders rush to buy, but hardly anyone checks volume. 2 days later, the breakout fails. The stock falls back below resistance. Thousands of traders are trapped. Now imagine the opposite. The breakout occurs with the highest trading volume in months. Institutions are participating. Demand is overwhelming supply. The breakout continues. The trend becomes sustainable. The charts looked almost identical. The volume told two completely different stories. What's coming next? Everything we've discussed so far leads to one powerful idea. Price shows the result. Volume measures the effort. But what happens when the effort and the result don't match? Why does massive volume sometimes produce almost no price movement? And why can tiny amounts of volume occasionally trigger explosive trends? That single question forms the foundation of one of the most powerful concepts in professional trading: effort versus result. And once you understand it, you'll never look at another chart the same way again. At this point, you already know something most traders never stop to consider. Price tells you what happened. Volume helps explain why it happened. But here's where volume analysis becomes truly powerful. It's not the volume itself that matters. It's the relationship between volume and price. Professional traders call this principle effort versus result. And if you understand this one idea, you'll start seeing institutional activity where everyone else sees random candles. Think like a detective, not a gambler. Imagine you're watching a professional weightlifter. He puts every ounce of strength into lifting a heavy barbell. His muscles shake, his face turns red. The effort is enormous, but the bar barely moves. Immediately, you know something is resisting that effort. Markets behave exactly the same way. In trading, volume is the effort. Price movement is the result. When effort and result agree, the market is behaving normally. When they don't, something important is happening beneath the surface. And that's often where professional traders begin paying attention. Case study number 1. High effort, small result. Imagine NVIDIA has just reported exceptional earnings. The headlines are everywhere. Financial media is calling it the next great AI opportunity. Retail traders rush to buy. Trading volume explodes to one of the highest levels of the year. But then something strange happens. Despite record-breaking volume, the stock closes only slightly higher. That should make you curious. If millions of buyers entered the market, why didn't price move much further? Because someone was selling just as aggressively. And those sellers weren't emotional retail traders. They were likely large institutions distributing shares into the excitement. This is called absorption. Public demand is being absorbed by professional supply. From the outside, everything still looks bullish. But underneath the surface, the balance of power is beginning to change. Case study number 2, low effort, big result. Now, imagine a completely different situation. A quality company begins moving higher. Volume is only slightly above average. No major news. No social media hype. Yet the stock keeps climbing day after day. Why? Because there isn't much selling pressure left. Even moderate buying is enough to push prices higher. This often creates stronger, healthier trends than dramatic rallies driven by emotional excitement. Sometimes, the quietest moves become the biggest winners. Stopping volume. When fear creates opportunity. Now let's examine one of the most misunderstood signals in volume analysis: stopping volume. Picture the market after several days of relentless selling. News headlines are overwhelmingly negative. Analysts lower their targets. Retail traders panic. Every rally is sold. Then, one trading session changes everything. Volume suddenly explodes. The stock drops sharply after the opening bell. But instead of closing near the day's low, it recovers most of its losses before the market closes. What happened? Most beginners assume heavy volume automatically means heavy selling. Professional traders know that's only half the story. Someone had to buy every share being sold. And during periods of panic, that buyer is often institutional money. They're not buying because the news is good. They're buying because prices have become attractive, while everyone else is rushing for the exit. This is why stopping volume is so important. It doesn't guarantee a reversal, but it tells you one critical thing. The selling pressure may be running out of fuel. Professionals don't immediately buy. They wait for confirmation. Patience is part of the edge. The psychology behind smart money. Markets aren't driven only by numbers. They're driven by human behavior. Retail traders usually react to what has already happened. Institutions prepare for what is likely to happen next. By the time positive news reaches the public, professional money may already have built its position weeks earlier. And by the time the public becomes convinced that prices can only go higher, institutions may already be reducing their exposure. This difference in timing explains why so many retail traders feel like they're always one step behind. They're reacting, professionals are anticipating, and volume often reveals that difference long before price makes it obvious. Question every trader should ask. The next time you see a huge green candle, don't ask, should I buy? Ask something much more important. Does the volume actually justify this move? If the answer is yes, the trend may have real institutional support. If the answer is no, you may be looking at nothing more than excitement. And excitement rarely lasts forever. Coming up next. So far, we've learned how institutions leave footprints through volume, and how effort versus result helps reveal hidden market activity. But there's one final piece of the puzzle. How do professionals recognize the exact moment when a trend is becoming exhausted? How can volume warn you before a rally begins to collapse, or before a downtrend quietly comes to an end? The answers lie in three powerful concepts: buying climax, volume divergence, and one of the most overlooked psychological traps in trading. That's where we're going next. By now, one thing should be clear. Volume isn't predicting the future. It isn't a magic indicator. It doesn't tell you exactly where the market will go next. What it does is reveal the behavior of the people moving the market. And once you understand behavior, you stop reacting to headlines. You start reading the market itself. Buying climax, when everyone wants to buy. Let's imagine a stock has been climbing for months. Every pullback has been bought. Every earnings report has exceeded expectations. Financial television can't stop talking about it. Social media is convinced it's the next trillion-dollar company. The public feels safe, almost too safe. Then one morning, the stock opens at another all-time high. Volume explodes, the biggest trading day in months. Retail traders rush in, afraid they'll miss the next move. For a few hours, everything looks perfect. Then the buying slows. The stock begins to fade. By the close, the candle is weak. Over the following days, momentum disappears. The trend stalls. What happened? The answer isn't that buyers disappeared. It's that professional sellers finally found enough eager buyers to sell into. This is known as a buying climax. Ironically, the strongest-looking candles often appear near the end of a trend, not the beginning. That's why experienced traders become more cautious when they see extreme optimism combined with unusually high volume. Volume divergence, when the market starts whispering. One of the earliest warning signs in any trend is something called volume divergence. Imagine Apple continues making new highs. Each breakout looks impressive. Financial media celebrates every move. But if you look beneath the surface, something has changed. Each new high is supported by less volume than the previous one. Price is still climbing. Participation is fading. The rally isn't necessarily over. But fewer and fewer buyers are pushing it higher. Think of it like a rocket running out of fuel. It may continue rising for a while, but the energy behind the move is weakening. The opposite is also true. A stock may continue making lower lows while selling volume begins to shrink. That doesn't automatically mean the downtrend is over, but it tells you fewer sellers remain. And when selling pressure dries up, it takes surprisingly little demand to change direction. Professional traders pay attention to these subtle shifts long before they become obvious to everyone else. A real-world mindset. Think back to some of the biggest moves in the US stock market. Companies like Apple, Nvidia, Amazon, and Microsoft didn't rise in perfectly straight lines. Every major trend included periods of accumulation, distribution, hesitation, and renewed momentum. The headlines changed every week, but one thing remained constant. Institutional money left footprints through volume. That's why experienced traders don't become emotional over a single candle. They study the relationship between price and participation over time. They ask, is this breakout supported by strong participation? Is heavy volume producing meaningful progress? Is the market confirming the move or quietly disagreeing with it? Those questions often matter far more than the latest news headline. The biggest misconception about volume, perhaps the biggest mistake traders make, is believing that high volume is automatically bullish. It isn't. High volume simply tells you that something important happened. Your job is to discover what happened. Was it accumulation? Was it distribution? Were institutions buying? Or were they selling into public enthusiasm? Volume provides clues. Price provides context. Neither should ever be analyzed alone. The 130-year-old lesson. More than a century has passed since traders first began studying the relationship between price and volume. Since then, markets have transformed. Trading floors became electronic exchanges. Algorithms replaced hand signals. Artificial intelligence entered Wall Street. But despite all that change, human psychology stayed remarkably consistent. Fear still causes panic selling. Greed still creates buying frenzies. Hope still keeps traders holding losing positions. And impatience still convinces people to chase moves that are already over. Technology evolves. Human behavior doesn't. That's why these principles continue to work. Not because markets are predictable, but because people are. Final thoughts. The next time you open a chart, pause for a moment. Don't focus only on the candles. Don't rush to draw trend lines. Don't immediately search for another indicator. Instead, ask yourself one simple question. Who is actually behind this move? Because every chart tells two stories. The first story is written by price. The second story is written by volume. Most traders read only the first. Professional traders learn to read both. And that difference can completely change the way you understand financial markets. If there's one lesson to take away from this video, let it be this. Price shows you what the market did. Volume reveals the conviction behind it. When those two tell the same story, trends become easier to trust. When they begin telling different stories, that's when the smartest traders stop, pay attention, and let the market reveal its next move. Thank you for watching.